Hey, Sats fans, welcome back to Swan Signal Live. I'm your host, Brady Swenson. Got a great show for you today with John Haar and Andy Edstrom, both Goldman Sachs alums. So we're going to get into what the culture of the legacy finance system is like, how it compares to Bitcoin culture, how Bitcoin might fix some of the problems of the legacy financial system. We're going to talk macro. We're going to talk also about how the fall of Rome parallels what might be happening right now in the United States. Is this the fall of the American empire? Should be a fascinating conversation. Hold tight while I talk to you for just a moment about Pacific Bitcoin. Pacific Bitcoin is the conference Swan is throwing in Santa Monica, California, a beautiful part of Los Angeles, right on the beach. We will be hosting about over 2,000 attendees. We're expecting. This is November 10th and 11th. At Barker Hangar. It's an old airport hangar at the Santa Monica airport. Really cool venue. Excited to have that just cool like airport vibe going on out there with this old giant hangar. It's really cool. It's an awesome vibe. We can make basically turn it anything we want to. So we'll be able to build out exactly the conference that we want to see. And it's going to be really fun. This conference is about community, and it's not just focused on Bitcoin education, although you will have plenty of it there from the best minds in Bitcoin, Lynn Alden, Preston Pish, Jeff Booth, and 50 others who you would expect to see on our main stage. We'll also have the Swan Dome, which is our tribute to Bitcoin culture, the Bitcoin community. We'll have some deep dive sessions there focused on education, privacy, mining, etc. But we'll also be having a lot of fun in the Swan Dome, a lot of entertainment, music, comedy, trivia sessions. We're going to have like a Swan Tank pitch session for small businesses judged by entrepreneurs in the space. So that's going to be a ton of fun. We also will have an amazing basketball court that we've got some incredible basketball players and talent coming over to demonstrate their skills. The professor, who is a YouTube sensation street baller, he has over 1 million followers, or I guess subscribers on YouTube. He's amazing. He'll be putting on a show. The Compton Magic, the best AAU team in the country, the best high school basketball team in the country, will be there with some future NBA stars. I'm sure they will be. And we will also have, of course, VIP areas for networking. So for all our VIP guests, it'll be a very amazing experience to talk with leaders in the industry, et cetera, network. Of course, parties, meetings, events scheduled throughout the week. We are finalizing details for those surrounding events. So it's going to be a fantastic time. Come down for the week. You can go to pacificbitcoin.com and join us in Santa Monica. Use code SWAN, SWAN, to get a 30% discount on your tickets at pacificbitcoin.com. All right, fantastic. Let's dive into the show with Andy and John. There's John. Hey, Andy, how's it going today? Andy is the managing director of Swan Advisor Services, the author of Why Buy Bitcoin, one of my favorite Bitcoin books, and you might be able, or you may have seen it over my shoulder in the intro. Andy, what's up, man? Welcome back. I think, what is this, your 10th show now?
Yeah, something like that, Brady, and it's always a pleasure, man. It's always a pleasure. It's back since the Citizen Bitcoin days. I think you were one of my earliest podcasts, and it's been an amazing journey, and I'm happy to share it with you.
Yeah, man, that was exciting. When you had launched or published Why Buy Bitcoin, I think it was one of the first or second show on Citizen Bitcoin. So that was a lot of fun. Known Andy since then, and here we are working together at Swan now. John, I'd like to welcome you to the show as well for your first appearance. How are you doing today?
Brady, it's great to be here. Looking forward to the. At some point, I have to upgrade my background, yet as fancy and well read as yours.
I listened to all of those books. I just buy them to put on my shelf to look pretty. All right. So as I mentioned at the top, Andy and John both worked at Goldman Sachs, which is, stalwart and anchor of the legacy financial system. And so I thought we'd kick it off by talking a little bit about your guys' experience at Goldman and inside Wall Street, the culture there, what you learned about how the legacy financial system works, and why you found Bitcoin as a possible solution to some of those problems. So let's kick it off with John. Since this is your rookie appearance, let's just go straight to you. Trial by fire.
Sure. And you guys let me know if I'm not coming in clear on the audio side for any reason. But I will. I recently put together a piece on this topic, and I laid out a few different reasons as to why I believe that legacy finance has issues with Bitcoin. Let's just say for now. I had 6 different reasons in there, but I think, let's just hit on the first one, which is the topic of what is money, what historically, how that changed over time, what it is today. It's not a topic that people spend really any amount of time on in the university system or to get to a job on Wall Street. I think that's the first and foremost thing to mention. And it explains a lot as to why legacy finance feels the way they feel about Bitcoin today. And I just want to make one other point for now, which is regarding specialization. And I think this is a really important one because when you work at a place like Goldman or any of these top tier Wall Street firms, you notice that the people who do their jobs at any part of the firm, whatever division it is, they're highly specialized, really smart people who know their part of the services world. But the specialization is so important because these people earn a living by knowing they're of the financial services world. They really have no incentive to question the fundamentals of the system, to ask the question, what is money? What was it historically? What is it today? And when and why did that change? And I wanted to give an analogy to make this point, an analogy to another industry, and that is the medical industry. I think the same thing is true in the medical industry, and this might be for people to see. So the way I would frame it is there are many great doctors out there, but oftentimes they know and they study only one part of the human body, or particular organ, whatever it may be, and they almost seem to forget that it's all connected. You can't just look at one organ or one system of the body in isolation and have an understanding of the whole. So one example within medicine, a really unfortunate one, is the fact that doctors have very little understanding of nutrition, which one could argue is the most important factor in wealth. So I think the parallel to finance is really appropriate here. The article I gave the example of corporate bond team that I spent 7 years working on. They could tell you everything about corporate bonds, issue spreads, yields, relative value, trading volumes, credit ratings, legislation, etc. But they spend zero time question of what is money. So I think there's a huge similarity to what you see doctors in the medical field. They go to med school, they spend years and years learning really complicated, specific things about the human body, but it's almost like they forgot to question, well, what about nutrition? And or even you look at that question and think about it, I think a lot of them just assume it's already fully resolved. And they end up telling people that a healthy diet follows the food pyramid, or a healthy diet is, high carb, low fat, that, what was kind of the dogma for many decades. But the reality is that they haven't actually spent the time to investigate whether that's actually true. And I think it's just a really appropriate parallel to what goes on in the world of finance. There's a lot of high performing people who are really good at their within finance, but they skipped over the part where they're supposed to examine the fundamentals of the system and ask questions like, what is money? Which unfortunately, I don't think you can just ignore those questions.
Absolutely true. But they are often ignored. Andy, you want to dive in a little bit to your financial education? Did you go through college in this line of study and not get exposed to the history of money or Austrian economic ideas?
Yeah. I was raised a Keynesian, right? I was born into the matrix. I studied economics in college, took a degree from a good school in econ, and it was all Keynes all the time. There was maybe a couple pages on what is money, right? Medium of exchange, store of value, unit of account. That was kind of it. there was a little bit of discussion on how the banking system worked in fractional reserve, and I kind of vaguely remember scratching my head, learning about that. Like, wait, they can just make more money. So I do have some memory of that. But yeah, John is 100% right. I think it's in the forward of Why Buy Bitcoin. I actually talked about my exact experience there. Not, spending much of a career, a good chunk of a career, over a decade without thinking about what the underlying characteristics of money are, what money is. No discussion of the Austrians, in my education, none of that stuff. I'll say another comment of John's, which I like, is the specialization one. And an anecdote I sometimes tell is senior leadership at Goldman Sachs. So at Goldman, the really ridiculous money comes when you make a partner. When I was at the firm, getting close to 20 years ago now, there was 2% of the total employee base was partners. And the average take-home pay as measured in US dollars at that time was believed to be roughly $8 million. So an average partner took home $8 million. Pretty good work if you can get it. And the thing that surprised me when I observed the activities of the partners, speaking of specialization, is they spent a lot of time managing conflicts, like a surprisingly huge amount of time, surprisingly large amount of time managing conflicts. And what I mean by that was what they had figured out at Goldman and other places on Wall Street was not only is the name of the game making as much money as you can, but then, by the way, literally as well as figuratively, but also the name of the game is squeezing as many dollars out of every transaction and every opportunity as you can that comes across your desk. So it means not just being the advisor on the merger deal, it means also providing the financing. It means also providing the hedging, if it's a commodity type business. It can also mean investing Goldman's own balance sheet in the transaction. When I was there, somebody was talking about a triple play, which was Goldman was playing three sides of the deal. And there was another partner who was proud to announce that he had figured out a quadruple play. He was playing four sides of the deal. Needless to say, all of this was before the global financial crisis. And surprise, surprise, playing multiple sides of the deal got Goldman in trouble, got all the banks in trouble. But that was the thing that surprised me in my early learnings as a young, bright-eyed analyst on the street, was seeing how much of the senior guys' time was spent managing conflicts so they could maximize the fiat profit from everything that came across their desk.
Relationship, and John, I'll kick this back to you. What's the relationship between Goldman Sachs and the like and the Federal Reserve?
Yeah, this is a loaded question. Probably things that happened well on my pay grade, but I can offer a few thoughts on that. So firstly, I'll say that I was in the asset management, or what we usually call the investment management division, while I was at Goldman. And so to what that means is rather than the investment banking division, or what we historically call the securities division, where you were helping firms go through capital markets or acting as a counterparty for trading, the investment management division was a fiduciary. And that means our clients' interests were aligned with Goldman's interests. We were not a counterparty. We were actually managing money on their behalf for a fee. So two thoughts that I would want to offer on this question. How do some of the decisions and activities that the Federal Reserve makes affect the part of the firm that I was in, and how I think it affects the part of the firm that I was not in, but I think the logic is what I'm about to say. So let's start with the was not in. If you, and actually before I even say that, I think a lot of this comes down to financialization of economy and the difference between saving money and investing it. I think a lot of the Fed's decisions and activities end up blurring that line where saving money is not an option anymore. It has to be invested, whether that means invested with like Goldman Sachs Asset Management, or it has to be invested in various other securities that are out there, and that's where the Goldman broker-dealer would come into play, and they would benefit from that. But one thing I want to throw out there is just this idea of who benefits from low interest rates, for example. Do you think the Goldman Sachs, and this doesn't apply to Goldman Sachs, it could apply to any big bank out there, but when interest rates are meant to be very low, debt is easy to come by, M&A ends up being very prevalent. The Goldman Sachs investment banking division is upset with that arrangement, that they're getting a lot of knocks on their door to help companies issue debt in order to buy back their shares, or help companies issue debt in order to acquire another. It's obviously a very, very good arrangement for them. It's very good for business. That's on the broker-dealer side, more specifically the investment banking side. On the asset management side, I think the very fact that the Fed exists and with all the things they do, it blurs this line between saving and investing. And you can't save money anymore because you can't simply save in a currency, which you used to be able to do for many, many years until the current modern fiat era. If you're an investment manager, you don't really mind this arrangement because you just happen to a lot of investment products which people are essentially fit into when they don't have the option of simply saving money. And most people don't have time to pick their own investments, so they end up having to go to a fiduciary who manages the investments for them. So again, that's a benefit for a large financial services firm. So maybe I'll leave it there in terms of how things that the Fed does end up impacting a firm like Goldman in different ways.
So, Andy, anything to expand on what John said there? Did you witness or were privy to any sort of relationship with the Fed, or is that just done, at the top of the organization and there's no, it just comes down from there, I guess, like a pyramid, for instance, like a fiat pyramid scheme?
Yeah. So one of the things I wrote about in Why Buy Bitcoin is the revolving door, right? This classic issue, and it's not unique to Wall Street. It's true of many industries, including healthcare, like John was talking about. But basically, ex-Goldman people going into government and ex-government people going to work for Goldman. And so that was ongoing. I mean, the classic case was Hank Paulson, CEO, leaving Goldman, ceasing to be a Goldman employee, taking advantage of this tax loophole, which says that if you go work for the Treasury Department, you can sell your stock and pay no capital gains tax.
Wow.
So that
nice.
was a pretty good deal for him. Now, he joined the Treasury. That's different from the Fed, but as we know, although Treasury and Fed are nominally separate, although the Fed is nominally independent, as a practical matter, when things get dicey in terms of the longer-term debt cycle, you tend to see more coordinated action between the Fed and the Treasury. We definitely saw that in the pandemic. My guess is we'll see more of it over time as we get into the later innings of this whole debt situation. But clearly, there's a sort of a incestuous relationship, let's say, between Goldman and the Fed, and really all major parts of the government that touch finance. Now, the second thing I'll say is something changed actually since I was there. So, being there pre-financial crisis, what happened, of course, was that all the investment banks had huge levered exposure to the housing market, as well as markets in general, and they got out over their skis. They were over-levered. Goldman was smart enough to take out insurance in the form of CDS contracts, credit default swaps. But the problem for Goldman was that their counterparty was insolvent, right? This was AIG. AIG had written these contracts, like an insurance company that writes way too many contracts, far more than it has the capital to support. AIG couldn't actually pay out all its counterparties, hence why the government had to bail out AIG and then by extension bail out Goldman. And so what happened during the financial crisis was they actually turned all these investment banks into bank holding companies, which are actually directly governed by the Fed to a greater degree than the investment banks were prior to the global financial crisis. It was, Glass-Steagall was this act of Congress that separated the investment banking functions from the commercial banking functions on Wall Street. And so the investment banks were, sort of separate, independent, more allowed to take risks of their own balance sheets on the logic that they wouldn't endanger the rest of the economy. Surprise, surprise, they did almost sink the rest of the economy and the financial system. So they had to restructure the system after the global financial crisis. But so today, Goldman is a bank holding company and is directly regulated by the Fed to a degree that it was not directly regulated as a pure investment bank prior to the global financial crisis.
So why did Goldman decide not to become an investment bank? Was there just more of its business tied up in the more traditional banking business? Is that?
Well, part of the deal, I don't know if we'll ever know sort of all the backroom conversations, Brady, but part of the deal with the bailout of the whole street in the global financial crisis was, guys, if you want to get saved, if you want to get bailed out, we're going to turn you into regular bank holding companies. Part of that, I believe, was regulatory. In other words, Glass-Steagall had separated investment banks from the commercial banking system in a way that made it harder. I don't know if it was legally harder. It was certainly sort of, in terms of, as we like to say on Wall Street, in terms of the optics, right? It looked bad for the federal government to bail out these swashbuckling investment banks. So part of the deal was, you guys turn into regular banks. That'll make it a little easier for us to bail you out.
Okay, so what happened to all the investment banking business? Was it spun off into another entity that's loosely related to Goldman?
If only. Yeah, no, it's all come back together, right? It's all it's all merged. The man behind the curtain was revealed. It became evident that even though the investment banks had been nominally and legally separated from the commercial banking system, they still took so much risk that they were able to nearly torpedo the economy of the U.S. and the whole world by extension. So yeah, no, it's they're more regulated now, so they can't be as levered. They have to hold more capital. It was Lehman Brothers was levered like 50-1 in terms of the debt versus the equity on their balance sheet. Goldman was something like 40-1. Okay, now they can't go over 10. So it's come with some restrictions on them for sure. But yeah, basically it's they've remerged the investment banks with the commercial banks.
Okay, so there's a couple topics here that are coming into question in my mind for John. So if we have, Andy mentioned fractional reserve banking, and also a new law basically limiting the amounts of a leverage a traditional bank holding company can have. What are those numbers now? What were they before? What are they now? And how does fractional reserve banking affect inflation? Like, what kind of pressure does it put on inflationary forces?
Yeah, good questions and loaded ones. I love it. The way I generally think about it is anything other than a full reserve banking system is prone to expansion and contraction. This is kind of the Austrian theory of the business cycle. it's an inherently unstable system when money can be created through the process of lending it out without someone actually having it before lending it out. This is one of those things, like Andy said, learning about it. The first time I learned about it, I didn't stand up and protest in the class, but I do remember learning about it and thinking, whoa, that's kind of funny. I didn't think it would work that way. So I think, this process of fractional reserve banking through the commercial banking system leads to these periods of monetary expansion. And I think this hits on one of the big misconceptions that we have about economics in the world today. It's that debt and money are not really the same thing. Especially in a healthy economy, they're not supposed to be the same thing. Unfortunately, we think that debt, or credit, just another word for debt, can act as the same thing, that they are the same thing, that they can circulate as the same thing. And I think this gets into the idea of fractional reserve banking, about monetary expansions and contractions and the boom and bust cycles that come with them. So to go through the logic here at a very high level, if a bank can lend money into existence without actually having that money, that is by definition what fractional reserve banking is, because if it was full reserving, they would have had to take the money from someone else who deposited it, and they would lend only that amount out. There would be no expansion of the money supply. The bank would just be a middleman who earned a fee on that transaction. But because they take in a certain amount of reserves, a certain amount of deposit out, far more than that. So to an expansion of the monetary system, as the credit that is issued to people and the money as well circulate as money at the same time. It's not as if they say to the person, hey, you deposited this, you can't access it, while the other person has this loan outstanding. The person who deposited it can access that money whenever they want. The person who received the loan will access that money at the same time, whenever they want. So this results in an expansion of the money supply. But the way the Austrians frame this, that it results in a boom period because these things at the same time. It does lead to inflation because, again, there's more purchasing power because the dollar used by the same people at the same time. Eventually, this system, the seeds of this, the demise of this system is kind of inherent at the beginning, because what happens is eventually there's going to be either defaults on some of those loans, meaning some of the people who took out a loan to use it for whatever they were going to use it for, their enterprise did not work out and don't be able to pay back the loan. Or even if they simply just pay back the loan and new loans are not made, it results in a contraction of the amount of money that is circulating through an economy. And that hurts a lot of business with which thought, okay, there's a certain circulating through this economy, but then as you track, everyone says, oh, there wasn't actually this much capitulating through the economy. And that's the bust period. And this is essentially a recession when a bunch of need to be unwound, and that's the painful process. I know I said a lot there. Maybe I'll pause there, but that's how I generally think about reserve banking and its effects on inflation, economic cycles.
Yeah, that's a fantastic summary of what fractional reserve banking is. I think useful to a lot of listeners. So, Andy, just to get this detail and an idea out to listeners, what has changed and how it might be affecting things. What was the number? Like there was a 30x, I think, what may have been the number that banks were allowed to lever up to, right? They could lend out 30 times their holdings. Is that where we are now? How has that fluctuated over time in your career?
Yeah, so I don't recall the effective limit. I'm not even sure there was one before the global financial crisis for the pure investment banks, because you have to wonder, like, if Lehman was levered at 50 times equity, okay. I'm not aware off the top of my head that there was some legal limit on pure investment banks. Okay, I believe the leverage level that's allowed now for bank holding companies, which they all are, is 10x, 10 times leverage. And, what counts as capital or regulatory capital or, the equivalent of equity is actually surprisingly complicated. You'd think it would be simple, but it's not. And so that's the legal limit today. And as a matter of fact, based on generally accepted accounting principles and based on their public filings, the U.S. banks are basically in compliance with the leverage limits. So that's a good thing. I mean, as compared to where we were with the global financial crisis back in 2008, 2009. Certainly there are some banks. By the way, I'm not going to say that every U.S. bank is in compliance, but for the most part, the big names, I believe, are. Certainly there are some European banks that are probably not in compliance with the Basel leverage limits. I doubt Deutsche Bank is, although it kind of probably depends on how you're running the accounting. There are some sort of chronically sick banks in Europe that really never cleaned up their balance sheets after the global financial crisis. So relatively speaking, the U.S. banks are arguably in significantly better shape on average than the European banks. Having said that, one of my concerns, even for the U.S. banking system, is there are still assets on the balance sheets of these banks that do depend on low interest rates, low discount rates, healthy businesses, and a lot of these companies themselves are indebted, right? They have leverage. So fundamentally, there is a risk to the banks, which is that if asset prices go down and stay down, your leverage level that looks like it's 10x might actually be 20x, might actually be 30x, because you may have to write down the value of the assets on your books. They're all valued at par today, or for the most part, they're valued at par. And so any significant impairment in the asset side of the balance sheet can lead to that leverage level rising significantly. So the system's designed to have enough capital, at 10x leverage for a downturn. And so we're in better shape than we were back in the financial crisis, but I wouldn't say that we're bulletproof by any stretch.
So speaking of Europe maybe being a little bit more vulnerable to this economic volatility that we're seeing right now, we're also seeing the same thing play out with energy resources. So John, would love to get your take on what's happening with energy prices in Germany and Europe as a whole, and what do we think this means from a macro perspective?
Yeah, I think the first thing to note about energy prices in Europe, typically look at price of natural gas in Germany. And amazing, Lynn Alden has got a lot of great research on this. It certainly has gone up a lot in 2022 after the Russia-Ukraine conflict broke out. But if you look back at the chart, it was increasing significantly before that conflict broke in February of 2022. So I think that's just important to note, because this has been a trend, an underlying trend for some time. And where I think this relates to the broader macro picture, if I could kind of tie it in, I think it ends up having the effect that there's going to need to be a good amount of government spending on to some of these really big issues that countries are facing, whether it's Europe or other issues that countries are facing. So maybe I could just give a few, like a bigger picture macro view. I generally subscribe to the thesis that there's essentially too much money. The federal government, this kind of applies to the US as well as Europe. There's too much money that the central government wants to spend. Tax receipts end up falling in a recession and falling when there is a stock market decline. And there's not enough natural demand in the form of government bond buyers or European government bond buyers to make up. So eventually this ends with the Fed or the ECB needing to engage in QE and step in as a buyer. Whether that happens in size 3 months from now or 2 years from now, I have a hard time in calling the timing. When you look at reasons why the Fed has stepped with QE in the past, it has been pretty hard to predict when they're going to do that. So that's kind of what I would throw out. Give some more thoughts on why we're likely to see more government spending, and maybe I'll pause there for now.
Yeah, let's bookmark that. Andy, do you have any comments on the European energy situation or just European macro environment in general?
Yeah, I think that Zoltan Pozar at Credit Suisse published an interesting piece recently, and one of the original ideas, or at least that I hadn't heard before, one of the ideas was the amount of operating leverage that sits on top of energy. And the idea being that, I think the number that he pulled out was 20 billion or so of annual natural gas imports by Germany from Russia. 20 billion on top of that 20 billion of natural gas energy imports is pyramided like 2 trillion of economic output. And granted, most of the value add in terms of the total economy is far greater, that's the point, than the energy input. It's like, okay, $2 trillion of output depends on $20 billion worth of energy input. Well, that's a problem if you lose access to that energy. The entire, German manufacturing base, whether it's the chemicals that use, the petrochemicals that use natural gas or other petroleum as inputs, whether it's the broader manufacturing base of Germany, which is hugely export dependent, right? They make all this valuable stuff that they export to the rest of the world. It all is dependent on energy. And so, that's been true in the modern age for a while, right? Energy has been a shrinking percentage of the overall economy. And that's sort of one of the major hallmarks of the digital age. But you got to have the energy, right? You're in some sense even more dependent on those inputs. It kind of makes me think of the food supply. I'm sure we're going to get into some of the stuff in history, but when you think about the industrial age or the information age, right, we've gone from most people or a large percentage of the population being food producers to like 2% of the population being food producers. So it's only 2% of the people, but that 2% is pretty important. If we lose that 2%, we all starve. So it's the same kind of dynamic whereby huge amounts of economic activity depend on energy. Energy is a critical input. And yeah, the dynamic in Europe is problematic because you've got the energy coming out of a now hostile neighbor and huge parts of the European economy being dependent on getting that energy from somewhere.
So, John, everybody's hanging on the words of Chairman Powell right now more than usual. He recently spoke at Jackson Hole and seemed to remain committed to raising rates. What's your take on the utterances of Chairman Powell as of late?
Yeah, I think this is emblematic of what I think is going to be the environment for perhaps the next decade. I think we're going to essentially oscillate between two sides here, where there's going to be points in time where relatively high and come out and talk a big game about raising rates, effectively reducing asset prices, demand throughout the economy. And that's, example, we saw that on Friday with what Powell said at Jackson Hole. But then there's going to be other times where inflation, I don't think it's going to go. When I say inflation, you're talking CPI. I don't think CPI year over year is going to go to zero anytime soon. It may drop to something like 4 or 5% for a print, or maybe a few prints in a row. And then I think the Fed will maybe wave a mini victory flag for a little bit. And the market will take that as, okay, they've broken the back of CPI inflation, and now rates won't go as high and as high for as long as people think. Maybe we're going to have a recession, because usually it takes a recession to reduce CPI in a material way. And then the Fed might have to respond to that recession next year by cutting rates, and therefore asset prices should rise. At least that's been the relationship for many years now. So I think we're going to oscillate back and forth between these two things for like I said, maybe a decade. But yeah, when there's a moment where everyone says, oh my gosh, the Fed is serious about hiking rates and reducing asset prices to hurt inflation, then things are going to sell off. But then we're going to go back and forth, and maybe the next CPI print we get, which I believe is just from now, if it comes in at something like 7%, then people may start to factor that in and say, okay, we're on our way to 4 to 5%, and CPI is not as big of a problem. Maybe markets rally as a result. So that's kind of the back and forth. I think we're going to keep a bigger picture. I think we're going to see something that's similar to the 1940s, which is essentially financial repression. And that means a fancy way of saying CPI is going to be significantly higher than the prevailing level of interest rates. So with all this back and forth about, is the Fed serious about fighting CPI? How much are they going to tighten? How long will they tighten? I think that's going to be this back and forth. But for the bigger picture is going to be, I think when we look back at the end of the 2020s decade, we're going to look back and observe that interest rates spent the vast majority of that time being well below levels of CPI.
Interesting. A lot of interesting stuff there, and I want to get Andy's take for sure. Real quick, though, a quick specific question on the top before you can build on what John had to say is 4 to 5% sort of the new target? Has that been stated by the Fed, or do we sort of interpret that 2% target that has traditionally held is now going to go to like 4%?
Yeah, now we get into Fed speak and expectations and posturing and all that stuff. So if you asked me, do I think that the Fed will actually practically settle for 4 to 5% annual CPI, more or less for the next decade as we deal with this debt problem, as John suggests? Yeah, I think that's probably pretty practical. Did the Fed say a couple years ago that they would let inflation run hot because, according to their measurements, inflation had been undershooting the target for a period of many years? Yes, they said that. Did it go too far the other way? Yes, also yes. So now they have a credibility problem. And so they really can't admit explicitly, I think, Brady, like you implied, they can't admit explicitly that they're going to target 4 to 5%. They have to make noises that they're going to get all the way back to the target of 2%. But yeah, I don't really believe that they're going to get back to an average CPI or PCE inflation level of 2% over the coming years. I think it's pretty likely that they're going to have to settle for something higher. But posturing that they're going to get back to their normal 2% level is important to them because they basically have to make investors believe that they're going to get to more normal levels of inflation. Otherwise, it becomes this self-perpetuating problem whereby people expect higher inflation on goods and services, so wage earners expect and demand raises, right? Wage increases, which raises the cost of production, which causes the further increase in prices of goods and services, and you get that wage price spiral that all the economists fear. So that's kind of my read of it currently with respect to what might actually happen, what the Fed has to say or pretend is going to happen, and where things might end up.
So you generally agree with John that we're going to, for the next 10 years, kind of go back and forth between easing and tightening and trying to balance inflation and recession, et cetera?
Yeah, I do. I mean, I think it's going to be a bumpy road. By the way, we should all have some humility about what the future holds. We don't really know. This is just kind of the best, base case scenario is, will average CPI inflation be higher this decade than it was last decade? Yeah, I think so. And will it be a very bumpy, oscillation between whatever 2% and 8 or 10%? Yeah, I think there's a good chance that's how it goes.
Bitcoin does love volatility, so maybe it will be good for a number go up over the long run. Okay, let's dive into financial advisors. And I want to talk for a minute about, Swan is building a product that Andy is leading called Swan Advisor Services. And I'd just like to hear a little bit about why you've decided to leave your financial advising company, group, practice, and decided to take on building a platform for advisors to manage their clients' Bitcoin allocations. What's the motivation for you?
Yeah, so the motivation for me for building Swan Advisor Services was as follows. There is, call it 30 trillion, roughly, dollars of managed wealth just in the United States. And globally, the number is obviously much bigger. And I had a realization, which is, I'm not the first to have this realization. Most people first buy Bitcoin as an investment. I mean, fortunately, it's there for those who actually need it to transact, right? That's the real use case for Bitcoin for a small minority in the short term, and then in the long run, if it reaches its potential, hopefully it will be frequently used to transact. But in the meantime, as this thing is monetizing, it's primarily an investment. And so there's all this managed wealth in the world, and especially in the US, that's thinking about Bitcoin, learning about Bitcoin, and wants some exposure. They primarily want the price exposure. So they face this decision point, which is, how do I get, the number go up technology and the diversification benefit into clients' portfolios? And so as advisors get up to speed on Bitcoin, and as they learn that it's a good investment opportunity, a great investment opportunity, they can either choose a paper product, right? Like some of the ones we know and love and hate. I guess I probably won't name specific other products, but they can choose one of those products that they can just buy in their brokerage account, or they can allocate to actual Bitcoin. And at the beginning, it'll be third-party custodied Bitcoin. But what Swan is building, what we're building at Swan, have built at Swan, is coins that can be withdrawn, from custody. And that is night and day different from the Roach Motel model, right? Where the coins come in, but they can never leave, of some of these other investment products. So the way I look at Swan Advisor Services is, at the margin, financial advisors and their clients are going to be making the decision to allocate some of their wealth to Bitcoin. And if we can, at the margin, bring some of those dollars into actual Bitcoin that can be withdrawn, self-custodied, or put into multi-sig arrangements in the future, then that's helping get actual Bitcoin into people's hands rather than paper Bitcoin in these centralized fund-like structures. That's a win for Bitcoin. It's also a win for Swan, obviously, because it's this huge untapped market. And so that's the primary motivation. That's the primary goal for me personally, as it relates to Swan Advisor Services.
Yeah, it's a fantastic opportunity to orange pill a lot of people. Financial advisors are trusted, with your finances, with your funds, with your investments. And this is a great place the financial advisor themselves to be teaching about Bitcoin and to be listened to closely about what Bitcoin means. So orange pilling financial advisors has that one-to-many effect. I think it's great for Bitcoin as a whole, and very exciting opportunity for Swan. So Swan Advisor Services is very close to being fully baked. We've got quite a few advisors who are using the platform right now to help us test it out, and we're really excited to open the doors soon to everyone out there in the country who is ready to start teaching their clients about Bitcoin and making it easily accessible to them through the platform. John, what's your take on the opportunity that the financial advisors market offers for Bitcoin, and then just parlay it into your work with Swan Private? What are you seeing right now in the bear market? What are your clients asking about, and what are they concerned about? What are they excited about?
Yeah, I would just echo everything Andy said. I think it's there's a great opportunity on the advisor side. There's so much wealth that is managed through advisors in the United States. There are a lot of people out there who trust their financial advisors. Believe it or not, there are many financial advisors who are positive on Bitcoin, but most don't have the ability to offer some Bitcoin investment to their clients and have it under their umbrella so that they can look at their clients' portfolios holistically. So I think it's just a great way to get people onboarded to Bitcoin, to have better ownership of Bitcoin rather than going into one of these paper products like Andy mentioned. In terms of Swan Private, so like you said, Brady, so I spent a amount of time talking to our client base at Swan, and given we are in this bear market, maybe it would be interesting to give some highlights as to what's happening there, what are themes that are coming out of those client conversations. First one that comes to mind is there are a good amount of people who I end up speaking with who say something along the lines of, I'm following Bitcoin for a while, a year or two. I was a little hesitant on it at first, but I've listened more. I feel better educated, and now that the price has pulled back so much, I feel ready to make an initial and take it from there. There's a good amount of people who are doing that, and I think it's just important because this feels quite different than the bear. This is my second bear market, so in 2018, I think the back then were a lot more dire, and people were wondering, is this thing done? People who were not so close to it. At least people at Goldman on my floor in 2018 thought, this whole Bitcoin thing was nice, but it's probably done now. And there was a lot of blockchain is great, and blockchain is here, but Bitcoin was just this experiment that failed. That was like a really common thing you heard in 2018. But I think even people in legacy finance are not saying that right now. Their critiques have changed, and I think that says a lot about just how sentiment has changed, whether people realize it or not. There are a good amount we get from clients about market entry strategy, about the time of how to enter the market. Obviously, everyone wants to time the bottom as best they can. But one thing I usually offer to people is, after having spent 13 years at Goldman, I saw a lot of sophisticated models that tried to essentially time entry into a particular asset. And that could have been very different asset classes like equities, fixed income, or it could have been a lot more specific, like the different subsectors within fixed income, when to allocate to treasuries versus municipals versus corporate bonds versus emerging markets, etc. And what I saw from all those models is they're very sophisticated. Sometimes they work, and when they work, people feel like a genius. But unfortunately, there's a lot of times when they don't work. and it just, gives the wrong signal, kind of garbage in, garbage out. You can't build a model to account for everything that's going to happen in the future. And I usually use that as something to highlight to our clients to say, look, I've seen people try to time the market who are professionals who are living for decades. Even they are wrong a lot of the time. So I think that's important to note. I think it is reasonable to use a market entry strategy that consists of a DCA that you split out over a couple months as getting to the number that you think to, and then during that time frame, if there is some sort of big sell-off, like a May to event for Bitcoin where there were a lot of syncretic things happening in the Bitcoin and crypto world, led to a lot of selling pressure, plus the macro environment was for Bitcoin then, and we got a price that dipped down to the 17,000s. Maybe you do an instant buy at that point, in addition to your DCA. I think that's a perfect reasonable strategy. But I think it's important for everyone to keep in mind that you're never going to fully time the market. So just for example, in mid-June, when Bitcoin did get into the 17,000s, there were a lot of people calling out there saying, it's going to 12,000 or 9,000 from here. And, that didn't play out. So you might find us waiting for a bottom that never comes. So those are some of the themes that come to mind as to conversations we have with SwanBitcoin clients.
That's great. I appreciate that. So I think we'll wrap up this portion of the show here and move over to Twitter Spaces for some live Q&A. So if you're listening on Twitter Spaces right now, we'll be over there soon. Think of any questions you might have for these guys that was prompted by the conversation. Anything that was outside of today's topics are fair game. Also, we'll be getting into parallels between the fall of Rome and present day United States, between the money of Rome in that era and the US dollar. So that'll be a fun conversation. John just visited Italy recently, was inspired to talk about it. I actually like to talk about this topic as well. So we're going to get into that and give you a little bit more time to come up with some questions as well and come up on stage and hang out with us. Questions, statements, anything like that is fair game. So we're going to wrap it up. I'll let John and Andy hop over to Spaces. Thanks, guys. I'll see you over there in just a second.
Thanks, Brady.
And just to remind you all, we are hosting Pacific Bitcoin. This is the biggest Bitcoin conference on the West Coast. It's in LA, specifically Santa Monica, November 10th and 11th. It's going to be a ton of fun. Come and network with the industry, see your friends from Twitter, and enjoy a lot of fun at the conference. We're going to do some different things. The Swan Dome I'm working on right now with BTC Sessions, Francis Pulio, and Brecky is going to be a ton of fun. I think it's going to be worth it just to come and hang out at the Swan Dome. But we have so much more at the conference, the basketball court I told you about, which is going to be going off with awesome demonstrations and games, etc. And of course, the main stage. We've got over 50 and growing. That list is growing, of the top Bitcoiners in the space to really dive into some cool stuff. We're also going to be doing some different stuff up on the main stage. So it's not going to be all exactly Bitcoin all the time at the conference. We're also going to kind of go off on some tangents. And I think Bitcoiners, being an intellectually curious bunch, will really enjoy that content. So check out pacificbitcoin.com. Use code SWAN, SWAN, at checkout for 30% off. It's a great deal. And also check out Hard Money, which is our new show, weekly news show that is hosted by the great Natalie Brunell and produced by the great team at Swan Studios. I'm really excited about this show, and I think it's going to find a place in the Bitcoin and financial media in the years to come, as it is such a professionally produced and hosted show. I'll give you a quick glimpse into that show, Hard Money with Natalie Brunell, and then I will meet you all over at Spaces.
Hello and welcome to Hard Money. I'm Natalie Brunell. Bitcoin remains in the high Hope House here in El Zante. It is a community center that does outreach at Bitcoin Beach. Look, the people got their own Bitcoin mobile.
I want to start a Bitcoin caucus with other elected officials across the political spectrum.
It turns everything brighter. Magic money, baby.
Goldman Sachs has offered its first Bitcoin-backed loan for cash.
Everybody knows the word Bitcoin.
The Bitcoin. Oh, Bitcoin. Bitcoin.
Bitcoin.
Sí. Economic freedom with Bitcoin.
On Hard Money, we'll bring you the top headlines of the week with analysis you won't find anywhere else. I'm Natalie Brunell. Welcome to Hard Money.